Happy Friday and good afternoon from the Shreveport office of Eagle Financial Management Services for the latest edition of the Jack and Bill Show here on July the 2nd of the year 2021. Stock market making all-time highs today pretty much across the board, except for the Russell 2000, the smaller cap index, which was down about 1%. So the S&P 500 year to date is now, Bill, up about 16.5% on a total return basis. That is after going up about 0.75%, or call it 32 points today. This has been a spectacular year. Thus far, coming out of the pandemic with tremendous amount of both fiscal and monetary stimulus, and the belief that things are rapidly improving with vaccination progress. So Dow was up just under 0.5%. NASDAQ Composite up about 0.8%. Today we had the June jobs numbers released, and the market really liking a pretty good beat today on the numbers. The mean forecasted estimate was around 702,000 new jobs created for the month of June across the board from all the analyst communities. And we came in at 850,000. And the unemployment rate actually did climb from 5.8 to 5.9%. So, we had gotten down to around 3.5 with the under Trump. And I think we're going to continue to see progress made there, especially as government incentives go away, not to stay home. So with the market beat, however, was a little bit of a surprise that the bond market was strong today, Bill. I mean, normally when you have a strong economic numbers like that, you're going to have industrials and cyclicals doing very well, and you're going to have the bond market selling off. But we had bond prices moving forward today. The bond market, since we had a little bit of a taper tantrum the last few weeks, the Fed talking about having to hike earlier than previously expected, we've seen the short end of the curve move up. 2-year Treasury note yield going from about 15 basis points this year up to about 25. So markets are starting to bake that in a little bit. I think that's actually much ado about nothing. But the talk is that the Fed is not going to be tightening until 2023, anyway. So other safe havens, gold was up $14 an ounce to $17.94. Silver up sharply, up 48 cents an ounce to $26.56. West Texas Intermediate has climbed over $75, closing at $75.32 today, up 25 cents a barrel, or call it 0.33%. Bill, I filled up yesterday at the pump and it cost me $2.99 for 87 octane. That was at Exxon. I couldn't get into Circle K. There were too many cars there.
You need a smaller truck.
I need a smaller truck. No, I don't think so. I'm going to stick with my my manly truck. And that's about it for the market wrap. I think we have an interesting talk today, William. What is it that we want to discuss?
Well, this was actually, Jack's suggestion that we revisit a worksheet that we maintain, and we've been maintaining this, over 10 years, I think. and it's entitled "The Fiscal State of the Nation." And it's something that frankly we don't like to look at very often because it is sobering and a little depressing. And when I was just thinking about this, Jack, when you're talking about the taper tantrum, the market's throwing a temper tantrum over the Fed's announcement of tapering. It's like the markets are a drug addict, and the Fed has to keep injecting methadone, to keep the addict alive. And I know that may sound extreme, but markets really are addicted to stimulus, monetary policy stimulus, especially. And there will be a coming to Jesus moment, so to speak, at some point in the future. We don't know when, but basically, in this graphic that we have a number of columns where we list data points such as real gross domestic product, the real GDP growth rate, federal tax receipts, federal tax outlays, and the difference between the two being a surplus or a deficit. But we haven't had a budget surplus since the year 2001. In fact, last year, our budget deficit was over $3 trillion. That's the largest in history. We also have on here our deficit to GDP, which, using real GDP, the deficit to GDP last year was 17%. That is astronomical. We also show our total U.S. public debt outstanding, and that is inclusive of intragovernmental holdings. At the end of the year, we're running almost, the numbers are so astronomical. I mean, we're running almost $28 trillion. And so using total public debt and real GDP, that's a debt to GDP figure of over 150%.
These numbers are through 12/31
of last year. That's correct.
Year.
To put that into perspective, in the year 2000, our debt to GDP was 43%. Now, there's obviously the elephant in the room. Obviously, is this debt outstanding, and there's a lot of concern about the debt overhang and the effect of the debt outstanding. What does that mean? What are the implications? Certainly, there are geopolitical implications because communist China is one of the biggest holders of U.S. Treasury debt. I know that some people have expressed concerns about the U.S. government defaulting on debt. That is a very extreme outcome. If the U.S. government defaults on its liabilities, we have bigger problems to worry about than that. I do believe that there will be other solutions besides that. But I think that there's something here that's very telling when we look at our growing debt, and it is growing exponentially, is that as the debt has grown exponentially over the last 20 years, we've seen the interest rates paid on our debt outstanding declining. So in the year 2000, when we had a budget surplus and our total public debt outstanding was below $6 trillion, the average interest rate on the debt was 6.6%. Now today, all right, so last year, 2020, with 28 trillion in debt, the average interest rate on the debt was 1.7%. Now this is counterintuitive. If this were an individual, a household, a business, as the debt outstanding grows, the interest rate that has to be paid to get new debt goes higher, and that makes sense.
It's artificial, though.
Well, it's artificial, but it makes sense because your credit worthiness declines as you become more and more indebted. Not so with the U.S. government.
not so far. You know, Bill, there's an interesting book that I read a few years ago, and Nouriel Roubini calls this a classic, but authored by Harvard professors Carmen Reinhart and Kenneth Rogoff, two economists that wrote this book entitled "This Time is Different," New York Times bestseller. 8 centuries of financial folly. They track all the nations that failed, you know, countries like Mexico, Argentina, Germany, Weimar Germany, anyway. But they came from the IMF. They're Harvard professors now, and they talk about what happens secularly over long periods of time. And the comments you make, Bill, about long-term interest rates or interest rates in general, what generally has brought on the failure and the high interest rates is when a nation reaches a point to where the general population no longer has the confidence in their ability to pay. And I don't think any nation is immune to that. So, and you know, there's something that we could talk through a few points here that I think are worthy of talking through. There's a huge crowding out effect that occurs when you get to deficits that you mentioned, 17% deficit to GDP. But the crowding out effect means economic growth is crowded out because of just the stagnation and staggering effect of you know, all the debt. And if you look at real GDP in America was 17.4 trillion in 2015, and it ended last year at 18.4. So it's only gone up $1 trillion in 5 years, in a 5-year period of time. And you know, the last time, now the pandemic, I mean, that's, you know, we ended 2020 with a decline in real GDP, and that's because of the pandemic. But the last time we had negative GDP, 2 negative quarters are generally defined as a recession. The last time we had negative growth, or that's not growth, I should say a decline in GDP, was 2009 with the subprime crisis. But we've had, you know, only 2 years of 3% or better GDP growth. But when you average it all out in the last 5 years, it's very, very slow.
Yeah, that crowding out effect. You know, if you think about it like this, these deficits have to be financed. Okay, so we have to borrow money to cover these federal budget deficits, and we're borrowing money through the issuance of treasury bonds. Those treasury bonds have to be purchased. The market has to absorb these treasury bonds. So you have capital going into treasury bonds that would otherwise be used for other purposes. So it's crowding out private investment as money is having to be invested into government debt. That's a simple way of explaining it.
No, that's true. You know, and I look here, Bill, at total U.S. public debt in the year 2000, which I think you mentioned. We had 5.6 trillion in debt. Bill Clinton was the president. It's the last time we ran budget surpluses in 2001. But the growth of that, I'm just looking at this right now, of the growth rate of our total U.S. public debt over this 19-year period is it's very close to double digits.
It's an error.
It's an error. I pushed the wrong button. Anyway, we'll come back to that. But you know, the alarming thing, the debt to GDP rate, debt to GDP. In 2000, we were, you know, 5.6 trillion in debt. That was 43% debt to GDP. Okay, so that's total U.S. Treasuries outstanding divided by the size of all goods and services, or gross domestic product in America. So that's, you know, 5.6 trillion over 13.1 trillion. Now fast forward, in 20 years time, real GDP went from 13 trillion to 18 trillion. I mean, that's just, if you were to contrast that with China, what do you think that would look like, Bill? They've certainly had way more than a double or two.
Oh, sure.
In there. So that's why, you know, China is the second largest economy in the world right now, on the verge of overtaking the United States. I mean, very soon.
All right. Well, here's a question. Perhaps our audience is asking themselves, what's causing this exponential growth in our debt? Why are we running these big budget deficits every year?
You know, it's quite insidious, I think. You know, and I think that America's a wonderful place to live, and you know, with our laws and so forth. Although there's been, you know, a decadence that's kind of crept in, and an insidiousness with fiscal spending. And if you think about it, if any politician runs on the elephant in the room, they have no chance of getting elected.
And what is that elephant in the room?
It's addressing issues like Social Security, Medicare, Medicaid, entitlement programs.
Spending.
Yeah,
that's where I'm getting at. When you look at our annual budget deficit for the federal government, or our federal budget, what you're seeing is that a larger and larger percentage of outlays is for entitlement spending. And it used to not be that way, but there is like nothing after we pay entitlement programs and below that defense spending. I mean, there is nothing left for discretionary spending. And so that number keeps getting bigger and bigger. And if you just think about the word entitlement, and this is not a broad judgment on anyone who's a beneficiary of entitlement programs, but it's just the reality. To think that we are entitled, that the government has to provide something, that's not the mindset of our founding fathers. And here we are coming up on Independence Day. The state of our nation right now, in terms of our fiscal state in particular, is not what our founding fathers had envisioned. The whole premise behind the founding of America and was limited government, and we're at a point now where government has grown so large, and the largesse of the federal government is taking over, and it's putting all of us into bondage because of this debt. I really can't describe it any other way than that. It is sucking life out of our economic growth, because we can address this in a number of ways. One is that we get stronger economic growth, and with that, higher tax receipts. That's the ideal. Everyone wants, but it's very difficult in this environment with the crowding out effect that we're witnessing. So we're going to continue to issue more and more debt, which will put a damper on economic growth. We're also going to be raising taxes, which also will put a damper on economic growth. So we're kind of in this position where there's no way out, really, without having to make some serious cuts to federal spending. That's my opinion.
Absolutely. I mean, it will, at some point in time, the elephant in the room, and I believe it's quite possible that the next recession could be something worse than what we experienced with the pandemic or with the subprime crisis, where these things have to be addressed. But Bill, I said I was going to come back to it. I just crunched the numbers. Our total U.S. public debt going from 5.6 trillion in 2000 to almost 28 trillion at the end of last year. That's a compounded growth rate of about 9% per year.
Wow.
Now, and our debt to GDP has gone up, compounded at about 7% per year. So we were 43% debt to GDP. We're now at 150.6. Reinhardt and Rogoff pointed out in their book that a number of nations start to experience a lack of confidence by the people of these nations when debt to GDP climbs up to 30%. 30% debt to GDP. We're now at 150. Now, I just said that, we've had almost a 9% growth rate of our debt outstanding to support all these entitlement programs. And guess how fast our economy has grown over that time period? 1.8%. 1.8% economic growth in real GDP from 2000 to 2020. I mean, that's the economic growth has it's been crowded out by this burgeoning, debt. And if you look, it's going to be interesting, because we're seeing some talks, and I think, this is done. We had spending. Doesn't matter whether it's Democrat or Republican.
No, they're both guilty.
Yeah, we ran. I think it's interesting to note here on the running budget deficits. Okay, again, we had two years of surpluses in 2001. Then in 2008, 1 year before the subprime crisis, our budget deficit ballooned. It doubled from 222 billion to 459 billion. Look what happened the next year. It had a fourfold increase with the subprime crisis to 1.4 trillion. Now that's 1.4 trillion, which is the second worst number, on our graphic. Right. Then look at what happened last year. 3.13 trillion, and 2021 is going to be a very large, a very large budget deficit.
We're just writing checks. Literally writing checks. Some people may be wondering how this can perpetuate, what gives us the ability to continue this. I think, one important reason is that the US dollar, has been the world reserve currency for a number of reasons. You look at, our role in global trade. You look at our military might, our rule of law. But if you examine each of those, we are on a decline in each of those areas. And we are declining in our global trade role relative to China. China is one of the main reasons why we're able to perpetuate this, because we have a massive trade deficit with China. So we are sending US dollars to China in exchange for cheap manufactured goods. China has these dollars. They have to do something with it. And more often than not, they're putting those dollars into treasury bonds. So this is how this perpetuates. Um, when I was saying earlier how I don't believe that the U.S. government will outright default on debt, but one thing we could see is the U.S. government inflating its way out of this debt situation. So, for example, the U.S. dollar, you could say it's the cleanest of the dirty laundry globally. Most developed countries are in a similar situation. Most developed countries are stimulating their economies through their central banks. We're not alone in this. But let's say that the dollar were to depreciate relative to a basket of foreign currencies, and we're seeing inflation, running higher and higher. Well, take your home mortgage, for example. So you're a homeowner, you have a mortgage. Let's say you have a 30-year fixed rate mortgage. As inflation runs hot, the value of your home is escalating, and the value of the dollar is declining, but you are servicing your debt with US dollars, and it's a fixed rate of interest. So interest rates are going higher, but you've locked in a fixed rate, and your house is going higher in value. So in effect, your debt is being inflated away. Your debt to home value will decline, and you're paying off your loan with dollars that are declining in value, depreciating in value. So that scenario could occur with the U.S. government.
Well, let me give you a scenario, Bill. What if I decided to sell my house, borrow $5 million to buy a monstrosity of a mansion, lever myself up as much as possible with a fixed rate, sub 3% home mortgage loan, with the belief that my home price will appreciate with rapid inflation.
Mm-hmm.
And I take advantage of the weak dollar and low interest rate scenario. Do you think that's a good idea?
No, it's not a fiscally sound idea, but it's not stopping people from doing that. It's certainly not stopping our elected officials from
Why
doing
isn't
that.
it fiscally sound?
It's the impact of leverage.
So what you're telling me is we really can't bank on that.
No, and the difference between a household or a business and the federal government is that the federal government has the ability to raise taxes. So the federal government can directly impact the money it raises. They can certainly they can raise taxes. They can basically print money. And you and me, we don't have that ability. We don't have an unlimited source of income like the federal government does.
I brought that up because I've actually had someone who's very successful in business, who's woken me up from a nap sitting in my chair on Saturday afternoon and asked me why he shouldn't do this. Okay. Or even get a home equity line of credit and put it into Bitcoin.
Well, it's like I said, the U.S. government, the U.S. government has an unlimited source, that is tax receipts, until it doesn't. But for you and me, or anyone watching, we're still dependent upon our ability to generate earned income.
Look at the growth of our federal tax receipts, though, Bill, from 2015. I mean, I'm going to tell you, we're going to see a tax hike.
We have to.
And I don't think we're going to see the receipts advance very much. And there is, that's the difference between the federal outlays and the tax receipts. Correct. Is what is, when you
higher taxation puts a damper on growth.
When you subtract one for the other, that's how you arrive at the surplus or deficit numbers. And because I've heard that a lot of the infrastructure plans that we have are going to create new jobs. There'll be more tax revenues, and that this thing pays for itself. I don't believe that for a second. Not trying to be political in any way either.
Well, one of the mantras of the American colonists prior to the signing of the Declaration of Independence was no taxation without representation. And there's probably a lot of Americans right now that don't feel very represented, especially those who are not receiving government entitlement payments.
Do you know where we are? You know what percentage of America gets a check from the government today?
It's the majority.
It's just become a majority this year. It's over 50%. And I think it will remain over 50% once everybody even goes back to work.
Right.
So we've crossed over from working America to
entitled America. And, it's easy to demonize, the high income earners. But the fact is that it's the highest income earners that are financing the government. And if we continue down this path of demonization of those who are successful in this country, they may just decide to leave. Anecdotally, we're seeing that in certain states.
Well, where do you want to leave to?
I'm not saying I'm going to leave, but
what are your departure plans?
I'm just saying that anecdotally, we are seeing people leave certain high tax rate states or low tax rate states. The two beneficiaries of this are the two obvious ones, Florida and Texas, because they have no state income tax. So we're seeing high income earners leave states like California and New York and New Jersey, and they're heading south.
Yeah. And, I read in today's Wall Street Journal that Japan is moving to a 4-day work week, or the government is now in support of that. And I think France has a 35-hour work week. Interesting.
Yeah.
So,
gosh, this is a very sobering show. But there's nothing that, on this that is fun and happy and joyful. I mean, this is just awful.
Yeah, this is awful. This is something that. So what do we do about this as investors?
That's a good question, because here's a mistake that a lot of people make and have made. And we ourselves, have had to be careful, because, looking at this data, it's very easy to get into a mindset that everything's about to implode. This is not tradable information. This is not anything that you can start trading on. This condition, this over-indebted condition that our federal government is in, could go on for a lot longer. Who knows how much longer? And in the meantime, we could see the investment markets continue to outperform.
Yes. Well, we've got, monetary inflation we just said to start the show today that the S&P 500 is up 16.8%. But I'll tell you, I will point this out, Bill, because I'll play devil's advocate and say, so far this year, the Dow Jones Commodity Index is up 23%.
Mm-hmm.
If you invested in crude oil, you'd be up 55%. Natural gas at 366 is up 44%. So, we've seen the birth and proliferation of cryptocurrencies. This year, commodity price increases, precious metals doing very well, gold making a big run in the last 5 or so years. And could you, how could you play? There are people shorting long dated U.S. Treasuries right now. with the belief that our interest rates are going to go higher. So, and I'll leave this with one. Here's one of the gloomiest questions, or I'll just make this a statement. I actually believe that there's some probability, you may have sent me this email the other day, that the Fed will never tighten again. Okay?
We may be stuck. We really may be stuck in this. I hope we're wrong about
Because every time they open their mouth about tightening, the financial markets get really upset.
Yeah, it's the addiction, the debt addiction.
So, well, we'll leave that to the prognosticators. And I think that's been enough doom and gloom for one day.
Gosh.
We'll try to brighten things up next week.
I think I need to go home and turn on the Cartoon Network.
Okay, couple of sports items.
I'm actually glad we're talking about sports.
LSU superstar Sha'Carri Richardson flunked her drug test.
Mhm.
Did you see that?
I did.
She wasn't taking PEDs, performance-enhancing drugs. She was smoking weed.
Oh,
So there's some controversy as to whether or not she should be allowed to participate.
wouldn't that make her run slower?
I actually, when I listened to her interview from winning the 100 meters, I actually think she was high. And I'm not sure. I wouldn't try to be a professional or do a high-level sporting event right after I lit up on weed.
Yeah.
Now,
How does that help?
I
How
don't
does that
smoke
enhance
weed for anything.
performance?
But on a positive note, 41-year-old Byrd High School graduate Meredith Duncan is playing on the LPGA, Lady PGA tournament this weekend.
Duncan.
I was eating dinner with my bride last night and noticed she had a Shreve baseball cap on. Came across the screen, hitting her driver. So I think that's about it for this week, Bill.
Yeah, I'm thoroughly depressed. Let's go home.
Well, all we can do as individuals is act responsibly. And in contrast to American politicians, and pray that they get it right.
Yeah, it was JFK who said something to the effect of it's not what the government can do for you, it's what you should do for your country.
That's right. Yeah. That's right. Well, let's try to do that. And we will see you next Friday with something a little brighter.
Yes.